the biggest fashion no-nos is wearing stripes and polka dots together, or mixing patterns. A real estate no-no is confusing your primary residence with investment real estate. Let me explain. A question that I've received several times in the last few months is that after selling your primary residence, how long do you have to buy a replacement property? This is actually a confusion of a principal residence sale versus an investment property sale, and there are different tax rules that are applicable in each of those situations. So let's look first at a primary residence sale. One of the best tax advantages of owning real estate is that if you sell your primary residence, you get to exclude the first $500,000 of capital gain on that sale if you're married, or $250,000 of capital gain if you're single. By the way, for it to qualify as your primary residence, you do have to have lived in the home for 2 of the previous 5 years. This means that, let's say for example, you've got a $700,000 gain on the sale of your primary residence. The first $500,000 would be taken tax-free, and you would pay long-term capital tax on the $200,000 gain over and above that $500,000 exemption, assuming that you're married, of course. So you take that $500,000 gain tax-free indefinitely. You do not need to buy another property ever again. You are welcome to, of course, but you will not pay $1 of tax on that $500,000 excluded gain in either case. Now let's use the same example, but look at it from the investment perspective. So this time you're a married couple, you're selling a property that's an investment property with a $700,000 gain. In this case, there is no exemption for any of that gain because it is an investment property. This is where you have a different tool available to you, the 1031 exchange. I have other videos on this concept that I've spoken about the 1031 exchange, but to avoid paying tax on that $700,000 gain, this is where you utilize the 1031. You've got 45 days to identify a replacement property after closing and 6 months to actually close on that investment property. So if your 1031 is successful, then the tax that you would have paid on that whole $700,000 gain is deferred. That deferral could be indefinite if you held that replacement property indefinitely. Now, if you were to sell the replacement property that you used to defer that $700,000 gain, you would then need to do another 1031 exchange when you sell that replacement property. It's a lot to follow. So there you have it. 2 different types of sales and 2 different strategies to ensure that you continue to grow your wealth tax-free. If you have any questions about selling a primary or an investment property and you want to discuss your plans and goals, please feel free to leave a comment below or reach out to me directly. I'm Jordan Bennett with Jordan Bennett & Associates. Don't forget to like and subscribe for more great real estate tips.